All right, well, we're going to go ahead and get started. If more join, we'll let them in as we proceed. But I want to thank everybody for coming out and attending this, listen to me, old school, jumping on a Zoom call this morning and learning about PPP Forgiveness, updates to that program and that are ever changing. It may change next week, but we're going to give great information this morning. We've got three wonderful speakers: Collin Kanelakos, Denver Todd, and Patrick Reilly, who are with Lane, Gorman, and Trubitt, LLC. And I'm going to not waste any more time. I'm just going to turn it over to these guys and let them tell you all about the Paycheck Protection Program and the forgiveness portion of that and whatever information they have to share. So it's all yours, guys.
Guess I need to unmute it. Hi, thanks for the introduction. I appreciate you all having us today. As Michael mentioned, we're from Lane, Gorman, Trubitt. We're a CPA firm. We were formed in 1950, Dallas-based, about 110 person firm. Our main niches that we serve are the dealership industry, construction contractors, medical practices, not-for-profits, manufacturing, real estate developers, 401k plans, and administrative questions that go along with that. And then as a firm, we've been very involved in the payroll protection plan from the beginning. We've had multiple webinars going over and educating folks on the subject. We've helped with initial applications, considerations for operational changes due to the funds, negotiating and estimating and managing the forgiveness, as well as working with clients with forgiveness applications, gathering and reviewing underlying data for the application, and then just advisory on that component. Presenters today, as Michael mentioned, it's me. I am Collin Kanelakos. I'm a partner with LGT. I have a main specialization in retailers, specifically dealerships. I have Denver Todd. He's a senior manager in our tax department. He too specializes in retailers, specifically dealerships. And then Patrick Reilly is also a partner with the firm. He too specializes in the dealership arena, but we do other areas. That's just where our bread and butter is. So wanted to let you all know this is not a 101 webinar. We're assuming everybody here at least knows about the PPP plan, eligible expenses, the basics, because if we went into all the details, this would be about a 2.5 hour webinar. As such, it'll still be over an hour long. So if there are questions that come up that are a little beyond what you know, feel free. If you've got questions, if you can, I'm not sure how we're going to be able to get questions. Typically there's a Q&A, but you all might be able to do a comment in the chat, and then we'll work on trying to address your questions, specifically if they have not been addressed in the webinar. When we're done with the webinar, we will have some opportunity for some Q&A if there's some additional unresolved questions that we think we can address. Regardless, we have a email address where you can reach out with other questions. It's askus@lgt-cpa.com. And then as you see here, we have a resource page, which allows you to be able to see the historical, let's see, I think we have historical presentations. So if you need that 101, I think we still have some of the 101 type presentations for the initial. And then there are some publications that we have issued as well. So let's go ahead and move on to the webinar and get started. So the first thing is always the disclaimer, the most important part. We don't know all your specifics for your situation. So of course, we're going to disclaim it. We're going to do our best to try to answer more generally based upon most common situations, but your advisor would possibly know more, and there might be some nuances that we do not know in our guidance. Let's go to the next slide. All right, the agenda. We're going to talk with the basics of PPP, not too much, but just give you that background. We're going to go over some recent guidance. Then we'll go over the two forgiveness applications. There is a full standard application, and there's an easy application. Then we'll go over the loan forgiveness process with lenders, and then we'll go over some common mistakes and common questions. All right, let me turn off my video just to make sure this keeps flowing along well. All right, timeline. So this all started back June 5th. Sorry. June 5th, we had some new information that came out. June 16th, we had release of revised loan forgiveness application and the easy application. And then June 30th, the president signed the bill to extend the application window to June 8th. So before, we all knew that the application needed to be completed by June 30th. And so there was a question of, well, how do we get all the applications in? Are there some companies that maybe haven't done it? Weren't sure if they should. They were kind of pressing up to that application. And just as they have in many other cases where we've been pushing up against a deadline, on that deadline, they extended it to August 8th. So, and then there were some revisions to the interim final rules. You'll hear interim final a lot because I don't think we've still gotten final, so they keep putting interim on all the guidance here. So June 11th, sorry, go back, June 11th, we had June 11th, 12th, 17th, and 22nd, we had revisions to the various rules. I won't go into all those details. Okay, so then we have the 8-week period versus the 24-week period. What we knew forever was that there was an 8-week period where you were able to use the funds for eligible payroll and payroll-related expenses and non-payroll items such as utilities and rent, and in some cases interest. And so what happened was that was changed to where it's an either or, and then it was further changed to be an either or in between. So what that means is anybody that filed their applications prior to June 5th, you have the option of using the 8-week period. We'll go over what the 8-week period really means versus a 24-week period. And then those that have applied and received loans at June 5th and later, they have a covered period of 24 weeks or less, okay? The other main change that we had was going through the majority of this process, everybody was planning and evaluating their use of funds at the assumption that you had to use at least 75% of your forgiven amount on payroll. And that changed to where you didn't have to use at least 75, you had to use at least 60%. Why is that important? Well, there's a lot of companies that initial 8-week period wasn't really enough to allow for the ramping back up of operations. What that means is that more of those funds could be used for rent and utilities, which allowed for the continued opening and keeping open and functional of those operations that weren't yet back to quote unquote normal. All right, let's go to the next. So what this also allowed you to do is, again, we were looking at the FTE and salary wage reduction penalties based upon reduction of headcount or reducing of salary and wages of greater than 25%. So what happened was that we all knew that there was this safe harbor that would allow you to get those reductions restored by June 30th. That was extended. So you have as far as December 31st. It doesn't mean you have to wait till December 31st. It just means that now you have a period of up to December 31st, 2020, based on what we know now. And we always have to remember that. This can change tomorrow, and who knows where it's going to change. Okay, other exceptions to the FTE reduction. And then we'll go into this a little bit more, but if you are able to rehire individuals who were employees of the eligible recipient on February 15th, and then if you hire similarly qualified employees, those are a couple of exceptions that are not FTE reduction penalties, or if you're able to return to the same level of business activity as before February 15th. Now, there's a couple of other questions, and we'll get to this in a little bit, but there are some, there's a lot of questions that come up about FTE reduction. And what does that really mean? And the main thing I would tell you on that is make sure that you're familiar with what the exceptions to reduction are. So if somebody quits, is that a reduction penalty for your FTE? If you have to fire somebody for cause, is that an FTE reduction penalty? If you furlough somebody and you rehire them, is that a FTE reduction? Those actually are all exceptions to that rule. So just make sure you're familiar with that. The main item here I wanted to mention to you about was the tax deductibility of the expenses paid with the forgiveness loan, because the actual rules right now are that the loan, when it's forgiven, that amount forgiven is not taxable income. But the IRS's rule is that if a situation like this, where typically debt forgiven is taxable income, this is the exception to the rule. So they clarified that any underlying expenses that fall into the forgiveness component of that loan will not be deductible expenses. Is this a negative? It's really not. You're still getting the loan proceeds effectively tax-free. You're just not getting the deduction. That would be kind of a double benefit if you could get the deduction on top of it. I've skipped over a couple of these items. The loan, if you have a loan at the end of the day, it's a 2-year loan. However, if you got your proceeds June 8th or later, it's a 5-year loan. I believe you can also negotiate with your lender to get up to a 5-year loan if you were before that. It's just not guaranteed. All right. I think we're good with that. We talked about interim final rules and incorporates provisions for the covered period and the 60% rule. I already covered that piece. And I think I'm going to turn it over to Denver.
Yeah, thanks, Collin. Okay, so I'm going to talk about some revisions to guidance that came out. So just a little bit of perspective. In the end of March, the CARES Act was signed into law by the president, and that incorporated the PPP loan program. And then in June 5th, the president signed this PPP Flexibility Act that was retroactive and essentially revised some of the rules that were in place when the PPP loan program started in March. Well, between the end of March and the beginning of June, there was guidance that had been released by the SBA and the Department of Treasury, and now they've gone back and started revising that guidance. So briefly, I'm going to go through each of these changes, and then I'll go through the application and a brief refresher on how all the rules work. Sorry, one second. Okay, so one of the first revisions on June 12th, to be able to qualify to apply for the PPP loan, if the owner that owned 20% or more was convicted of felony within the last 5 years, that business could not qualify for a PPP loan. They've reduced it to 1 year as long as the felony is not for fraud, bribery, or embezzlement. Then on June 17th, this interim final rule, so revisions to the 3rd and 6th interim final rules, these rules were gave guidance on how self-employed taxpayers would, how they would apply for the loan, and then also how the forgiveness portion would work. So the SBA has gone back and revised that because of the PPP Flexibility Act that Trump signed. So the main one is the eligible payroll cost per employee. It was originally over an 8-week covered period. It was going to be $15,385. Well, now if you, it's actually the default is that you're going to use the 24 weeks, but then you have the option to use the 8 weeks. So if you choose to use the 24-week period, you can count eligible payroll costs per employee up to $46,154. And I'll go more into the definition of what payroll cost means and then even what the covered period means. Okay, so owner's compensation replacement. This is for self-employed self-employed taxpayers. So it's now going to be capped at the lesser of 20,833 or 2.5 months worth of 2019 net profit for if you're using the 24-week covered period. That 2019 net profit would be coming from the self-employed taxpayer. When they applied for the loan, they would have had to provide their Schedule C from their personal return to get the loan. So there's a limitation. If you didn't make that much money in 2019, or you didn't have a lot of net profit, you're going to be limited to 2.5 months of that net profit, or the 20,833. And then if you choose to use the 8-week covered period, you're going to be capped at the 15,385 instead of 20,833. Okay, so this is a big question that's come up a lot. So on June 22nd, the SBA and Treasury came out with more guidance. A big question was, if I'm going to use the 24-week covered period, what happens if I use my funds before the end of the 24 weeks? Can I go ahead and apply for forgiveness before the 24-week period is over? And the answer is yes. So just to read right here, it says a borrower may submit a loan forgiveness application anytime on or before the maturity date of the loan, including before the end of the covered period, if the borrower has used all of the loan proceeds for which the borrower is requesting forgiveness. Now, there's a catch to this. If you're going to apply before your covered period's over, the second paragraph right here, if the borrower applies for forgiveness before the end of the covered period and has reduced any employee's salary or wages in excess of 25%, the borrower must account for the excess salary reduction for the full 8-week or 24-week covered period. I have an example in a second how that works, and I'll go over how the excess of 25% calculation works. It's essentially this PPP loan program. When you applied, you submitted essentially 2.5 months of your payroll costs from 19 when you applied for the loan. You got the loan, and then when you receive the loan proceeds, a covered period date starts. You use your money within that period, and you think, oh, I'm going to get it all forgiven. Well, there are some limitations where if you have reduced your headcount or you've reduced employee salary over that covered period from when you got the loan, there can be limitations on how much forgiveness you can actually receive at the end of the day, meaning if you don't get full forgiveness on the loan, then you'll owe money back to the lender that you received the loan from. But in this case, back to this, if you do apply for a loan forgiveness before the end of your covered period, you will have to figure out if you've reduced your employee's salary in excess of 25%, and you have to have a reduction for the full period. So here's how this works. A borrower is using the 24-week covered period. The borrower reduced a full-time employee's weekly salary from $1,000 per week during the reference period to $700 per week during the covered period. So what's happened here is the employee's salary was reduced by $300. So that's 30%. And then it says the employee continued to work on a full-time basis during the covered period with a full-time equivalency quotient of 1.0. In this case, the first 250, 25% of the 1,000 is exempt from the loan forgiveness reduction. The borrower seeking forgiveness would list $1,200 as a salary and hourly wage reduction for that employee. What it's saying here is, so in the reference period, which it's going to be the Q1 of 2020 or January 1st through March 31st of 2020, they made $1,000. Then this employee, or when the borrower received the loan proceeds over the covered period, they were getting paid $700 per week. So when you compare the 700 to 1,000, they had a 30% reduction in their weekly pay. So that's more than 25%. Only the excess over 25% is the reduction. So that's going to be the $50. 300 minus 250 is $50. What it's saying here is if you go in, let's say you get the loan and you use all your proceeds within the first 4 weeks. Well, if you're to do the math, you'd think, okay, I paid this employee in excess of a reduction of 25% or more of his salary, $50 for the first 4 weeks, so the reduction would only be $200. Well, that's not how it works. What they're saying is the reduction applies to the full covered period, even if you apply for the loan early. So it's going to be $1,200. So 50 times 24, that's how you get the 1,200. And it says if the borrower applies for forgiveness before the end of the covered period, it must account for the salary reduction for the full 24-week covered period, which is $1,200. And then here's another example, the same thing. It's based on if the borrower was using an 8-week covered period. The math works exact same. So I won't go over that. Okay, so back to the timeline. So the PPP loan program started at the end of March is when it was signed into law. You could begin applying in early April. Then the president signed the Flexibility Act on June 5th. Well, when the president signed that Flexibility Act that made revisions to the rules, there was already an application out that had been published by the SBA that provided rules on how you'd go about applying for forgiveness. Well, they had to, after the president signed the June 5th law, they had to go revise the application, which we're going to talk about in a slide or two, but they also came out with this easy loan application, which was unexpected, but it's actually very good for the borrowers if they could, if you can use it, because it makes the whole forgiveness application process a lot simpler. So this application, it's a one-pager, and then there's some certifications you have to certify on following pages, and it's going to apply to self-employed borrowers with no employees, any borrowers that did not reduce salary or wages of their employees by more than 25% and did not reduce the number or hours of their employees, or the borrower experienced reductions in business activity as a result of health directives related to COVID-19 and did not reduce their salary or wages of their employees by more than 25%. So as mentioned, this form provides fewer calculations. There's less documentation, whereas you don't have to do the FTEs where you look back to the prior periods. And I went through those who it applies to very quickly. It's because on the next page, I'm going to go through it a little bit in more depth. So this is from the instructions of the Form EZ. And the whole reason I'm going through this is because if you're able to use this easy application, it's going to make your life a lot easier. So if you can meet any of these check boxes here, you'll be able to apply for it. Or I'm sorry, be able to use the form when you're applying for forgiveness. So this is directly from the instructions. It says the borrower can apply for forgiveness using this form if you can check at least one of the 3 boxes. You do not have to check all 3. You only have to check one of the boxes. So this is just regurgitating what was on the previous slide, but in more detail. So the first checkbox, you're a self-employed individual and you have no employees. You'll be able to check that box and use the application. Now checkbox 2 and 3, this is where it gets a little bit more complicated. I don't think many people will be able to use number 2 if you're a borrower with employees. It's going to be pretty difficult, I would think. But number 3, I think, will be more favorable. So let's go through each one. So number 2, the borrower did not reduce annual salary or hourly wages of any employee by more than 25% during the covered period or the alternative covered period compared to the first quarter of 2020. And the borrower did not reduce the number of employees or the average paid hours of employees between January 1st and then the covered period. So that might be a little bit more difficult for borrowers to meet that second paragraph in box 2 because it's from January 1st through the end of the covered period. And remember, the covered period could be the 8 weeks, or it's going to be the 24 weeks unless you're able to elect to use the 8 weeks. But you're basically saying that you did not reduce any number of employees or their average paid hours essentially for all of, I mean, up until now of all of 2020, which might be hard for people to meet. Now, this third checkbox down here might be a lot, some people might be able to meet it because of the second paragraph, but so checkbox number 3, the first paragraph's the same as checkbox number 2. You did not reduce your annual salary or hourly wage of any employee by more than 25% during your covered period compared to Q1. And then this last paragraph here, the borrower was unable to operate during the covered period at the same level of business activity as before February 15th. Due to compliance with the requirements established or guidance issued between March 1st and December 31st of 2020 by the Secretary of Health and Human Services, the Director of Centers for Disease Control and Prevention, or the Occupational Safety and Health Administration, related to the maintenance of standards of sanitation, social distancing, or other work or customer safety requirements related to COVID. So basically, if you had to make changes to your business because of COVID, you had to do social distancing, you couldn't have as many employees on site working, and there was just a general decline in your business activity compared back to before February 15th, you should be able to meet this exception right here. And then if you meet the first paragraph of checkbox number 3, then you'd be able to use the easy loan application, which should make your life a lot easier. Now let's talk a little bit more about this last paragraph on the next slide. A lot of people are going to ask, what do you need to support that? So in the application instructions, it essentially says you must include copies of applicable COVID requirements or guidance for each business location. So any guidance related to you must social distance, maybe your business is not essential and you got to close down, anything related to that. It's something just to be aware of, and relevant borrower financial records. So the reason I bring that up is because if you read back on here, it says the borrower was unable to operate during the covered period at the same level as business activity before February 15th. So if your business actually increased during your covered period, I'm not so sure you'll be able to qualify for this. And a lot of you are probably thinking, well, a lot of people closed down. There actually have been some businesses, some of the clients that I work with, their business actually increased during COVID-19. So it'd be harder for them to meet this exception. But big picture on this easy loan application form, just to reiterate, if you're able to use it, you should use it because it'll make your life a lot easier and there'll be significantly less calculations that you have to do. So you should strive to be able to use this form. And here is an example of that last paragraph I was just discussing. A PPP borrower is in the business of selling beauty products both online and at its physical location. During the covered period, the local government where the borrower store is located orders all non-essential businesses, including the borrower's business, to shut down their stores, based in part on COVID-19 guidance issued by the CDC in March. Because the borrower's business activity during the covered period was reduced compared to its activity before February 15th due to compliance with COVID requirements, the borrower satisfies the Flexibilities Act exemption and will not have its forgiveness amount reduced because of a reduction in FTEs during the covered period. And then it says if the borrower in good faith maintains records detailing the requirements. This safe harbor that I'm talking about is actually applies for the long form too. And if you're able to meet that paragraph, then if you have reductions in your employees, it's basically like a get out of jail free card where it's not going to affect your forgiveness. So just to recap, before I talked about the easy loan application that came out, and now I'm going to go back to this, what I call the long form or the regular loan forgiveness application. And this was actually released back in May, but it had to be revised because the president signed the new law in effect on June 5th. So this form is going to be very similar to the original. There's the new certification that I just spent the last 5 minutes talking about, relating to if you had a reduction in headcount. There's some clarification on what costs count. We'll get into that. And then there's also, just to mention, the mechanics of calculating the FTE and salary and hourly wage calculation did not change that much. So what I'm going to do here is I'm going to go back through a refresher of the different rules, just to recap how they've changed based on all the guidance. I mean, this stuff it was changing almost every few days. The last week or two, it hasn't really changed, but just to give you a recap so you're up to date. Okay, so that covered period word that I keep referring to, that's it's the 24-week period beginning on the date you first receive your loan proceeds. And if you choose to, and you received your loan before June 5th, you can actually elect to use the original 8-week covered period. And just big picture on this, to decide the whole idea behind this is you want to maximize your forgiveness. You want to get as much forgiven as possible. So you have to run the numbers on the 8-week to see if you're getting full forgiveness. And if you're not, then you might want, and you got your loan before June 5th, then you would think about possibly using the 24-week period. You have options, and you got to run the numbers on both to see what benefits your business the best. Okay, and then there's also this alternative payroll covered period. So borrowers with a biweekly or more frequent payroll schedule may elect to use the alternative payroll covered period, which essentially it allows you to line up your payroll. It allows you to line up the covered period with your payroll cycle, and this is only for payroll costs. So if you got the loan in the middle of your in the middle of a pay period when you receive the proceeds, this would allow you to start your payroll cover period on the first day of the next payroll cycle that starts, and this would only apply for payroll costs. Any of your non-payroll costs you cannot do this for, and you have to have a biweekly or more frequent payroll schedule to be able to use this alternative payroll cover period. Okay, so we talked a little bit about the covered period. Now let's talk about what costs are eligible for forgiveness. This hasn't changed much. I'll briefly go through it. It's your gross salary, gross tips, commissions, paid leave, allowances for basically severance that are paid or incurred during the covered period. This is important. I have an example in a second, but this is something that a lot of people have trouble grasping at first. There's just a lot of going on with this PPP loan calculation, and it's important to understand how this paid or incurred works, because it could be the difference between you how much is forgiven if you're not including all the costs that you rightfully should be able to include. Then for each individual employee, I spoke about this later, but if you have annual salary in excess of 100,000, there's a limitation to how much you can count in your covered period. So you have to annualize 100,000, and what it comes out to be is, if you're using the 24 weeks, the maximum you can count in your forgiveness calculation is 46,154. That's taking 24 weeks divided by 52 weeks and multiplying it by 100,000. Or if you're using the 8-week covered period, it's 15,385. How that number is derived is you're taking 8 weeks divided by 52, multiplying it by 100,000. That's where these numbers are coming from. So there's also, what you have to look out for is there's also limitations on amounts paid to owners. And owners are defined as a C Corp or S Corp, owner employees, any self-employed individuals, or general partners. So the 24-week is capped at 20,833. or 2.5 month equivalent of their 2019 compensation, whichever is lower. So if you have someone that comes in and is an owner of your company in 2020 and they receive no compensation in 2019, you wouldn't be able to count any of their compensation as eligible costs for forgiveness. It seems very unfair, but that's how the rules are written right now. I think what they're trying to do, um, unfortunately, what a lot of people thought about doing is some people wanted to increase their payroll costs in 2020, so they go and employ all their family members and then pay them. And this is the government's way of trying to prevent that. They only want you to be able to deduct up to what was in 2019. And then
One thing I'd add to that is that then there were some other employers who had historically taken paychecks, or they had multiple businesses, and maybe they took a paycheck out of one and they said, well, why don't I just go ahead and get paid out of each of my businesses since I'm already doing the work? And this kind of closes that loophole. The loophole the thing that it closes that doesn't quite make sense, but appears to be the case, is that if it's a business that started in 2020 and your loan was based upon wages during that first period of 2020 as opposed to 2019, those owners didn't have wages during 2019. Therefore, it appears that they are precluded from getting forgiveness for their loan or for their portion of the wages, which doesn't make any sense at all. But we haven't gotten clarity on that.
Okay, thank you, Collin. In this, if you look at the 24-week or 8-week period, it says their applicable compensation in 19. This next slide just defines what the applicable compensation is. So for a C Corp owner employee, it's going to be your cash compensation plus the employer's retirement and health insurance contributions made on their behalf. In S Corp owner employees, it's going to be their cash compensation, employer retirement contributions. You do not get to include your employer health insurance contributions because as a S Corp owner employee, that should already be included in your W-2 wages because it's considered a taxable fringe benefit. And then down here at the bottom, general partners, it just defines what that is. And then we talked about what payroll costs are, and Collin mentioned it earlier. Your loan can be limited up to 60% of your payroll costs. So there are also Oh, I'm sorry. This is also in including. I jumped ahead too far. So your payroll costs, what I just talked about, was cash compensation. The cash compensation has a limit to how much you can count. It's that 15,385 or the number for the 24-week period. But there's also non-cash compensation that will count towards payroll costs. And this is your employer contributions for employee health insurance, employee retirements. So it's the employer side, not the employee's contributions. And then also state and local taxes assessed on employee compensation. That'd be anything you're paying to the Texas Workforce Commission if you're in Texas for unemployment. So you'll add your cash compensation, your non-cash compensation, that's going to be your payroll costs. So the big question is, when do they have to be paid? So paid or incurred during the covered period. So they have to be paid or incurred. So they're considered paid on the day that paychecks are distributed or the borrower originates an ACH transaction. Payroll costs are considered incurred on the day the employee's pay is earned. So what this means right here is payroll costs incurred but not paid during the borrower's last pay period of the covered period are eligible for forgiveness if paid on or before the next regular payroll date. So I have an example of how this works on the next page, and last but not least, you can't double dip on paid and incurred. Excuse me. Okay, so here's our example. You get your loan on April 10th. You're going to use the 8-week period. cover period. So your loan's going to end on your cover period's going to end on June 4th, which is your 56th day. You're an employer that pays your employees semi-monthly, one pay period in arrears. So if you focus on this first row, you have wages that were incurred on March 16th through the 31st. These were incurred before April 10th when you received your loan proceeds. So you'd think, okay, I can't include those wages. Well, actually you can, because you paid them on April 15th, which was during your cover period. So it's essentially you're on the cash basis at the beginning, and then you're on the accrual at the end of your cover period. So if you skip down to the May 16th through May 31st, those wages were incurred, but they're not paid until June 15th. As long as they're paid by the next regular pay date, which is June 15th, you get to include them. And then also you have wages incurred from June 1st to June 4th, and they're paid on June 30th. You would get to include those as well. Just those first 4 days of that 14-day period. So what ends up happening is you get about 10.5 weeks of payroll costs that you get to include because it's paid or incurred. Just make sure you're including paid or incurred, because it should, a lot more employers, if they weren't shut down, I'm sorry, borrowers should be able to get closer to their loan amount for the 8 weeks by using this. So I talked about the payroll costs. There's also non-payroll costs. These are going to be limited to 40% of your loan amount when you apply for forgiveness, or they're going to be limited to 40% of your forgiveness amount. And we'll see how the calculation works in a little bit. So it's going to be business mortgage interest payments. The obligation had to be incurred before February 15th. You cannot include any prepayments or principal. Rent or lease payments, as long as the lease was enforced before February 15th. The instructions actually require you to provide the lease agreements when you apply for forgiveness, so you need that agreement. And then any business utility payments for service that began before February 15th. A lot of people have asked, like, what does transportation mean? Has the government issued any guidance? The only thing they said, one thing is in the self-employed guidance, they said gas for a company vehicle would count, but that's all they've said, nothing else. So it's just a bit of an unknown. So hopefully you're not banking on something that you think fits in the transportation definition as part of your non-payroll costs, because it's not a guarantee that you'll get it. I would definitely speak to your lender about that, because they ultimately approve the applications. So the costs eligible for forgiveness, your non-payroll costs, they are the same as your payroll costs. It's paid or incurred. Okay, so how much of the loan will be forgiven? It's determined by how much you spent on payroll costs and non-payroll costs during your covered period. So you get your loan, you spend the money, and then if you spend all your money within the 8-week or 24-week period, then you'll go to apply for forgiveness for that amount. But you just have to, there's limitations if you spend more on non-payroll costs than payroll costs, because your non-payroll costs are capped at 40%. It used to be 25%. And then, as I spoke about earlier on in the presentation, your forgiveness amount can be reduced if you reduced any employees' wages or their headcount during the covered period. And it will also be reduced if you got the EIDL advance, the $10,000 advance. So this is the worksheet on the long form. I'll briefly go through this. The first reduction that you have to calculate is on this worksheet is that salary and hourly wage reduction. That's on the far right column of table 1. What's important to know about this is you're only doing the salary and hourly wage reduction on employees that were employed at any time during your covered period. So if someone was let go before the covered period, they would not be on this table. So the difference between table 1 and 2 is that in table 2, if you have any employees that received compensation at an annualized rate of more than $100,000 for any pay period in 2019, you do not have to figure out if you reduce there is no salary or hourly wage reduction on those employees. Meaning if you had someone that, let's say, made $150,000 in 2019 and you reduce their wages down to where they're getting paid nothing during the covered period, you would have no salary and hourly wage reduction on that employee. And then secondly, if you had any employee that when you annualize any of their pay periods and that pay period that they got paid is over 100,000, they would fall back into table 2 and you would not have to do the salary and hourly wage reduction. So on the bottom of this slide right here, if you're an employer that's, let's say you pay your employees on a weekly basis. So there's 52 pay periods. If you take 100,000 divided by 52, that's $1,923. If any pay period in 2019 you paid someone over that amount for that pay period, maybe they got a bonus in addition to the regular pay and it bumped them over the $1,923, then they actually go into table 2 right here and you don't have to do a salary and hourly wage reduction calculation on them. In this, if you do have employees that you do have to calculate the salary and hourly wage reduction test on, what it is you're testing to see if during the covered period you look at how much they're paid and you compare it to quarter 1 of 2020, which is January 1st through March 31st. And if you reduce their salary or their hourly rate, if they're an hourly employee, by more than 25%, it's possible you could have a reduction, and there's some safe harbors. I'm not going to go through everything on how this calculation works because it's pretty intensive and it would take up a lot of time. But what we have found is most borrowers are not running into this because they have paid their employees at least 75% of what their Q1 wages were. So I'll briefly just go through what has changed regarding this test. So here's the steps of how you calculate it. Basically, you're taking you have to figure out how much they're paid over the covered period. If they're a salaried employee, you have to annualize what they're paid over the covered period and then compare it to Q1 of 2020. If you paid them at least 75% of their annual salary over the covered period compared to Q1, you're going to be okay. This test isn't going to affect you. However, you have to do this on every employee that is in table 1. So this can be quite extensive. If you have an employee that is an hourly employee, you're not looking at what they were paid in total, you're looking at what their hourly rate is. So if they're making $10 an hour over the covered period and they're making $10 an hour during the first quarter of 2020, then you're okay. Their hourly rate did not get reduced by more than 25%. And one thing to mention on this, if you have an employee that you hired in the covered period that they didn't work in Q1, then you don't have to do the test on them because there's nothing to look back to. But if you rehired an employee that you had in Q1, you would have to do the test. But when you're doing the annualization, if they're a salaried employee, you'd only annualize based on the time they're employed in the cover period. So if, let's say you're using the 8-week cover period and they come back in week 7 and 8 and they weren't employed during week 1 through 6, you would take what their annualized salary is for week 7 and 8 and then compare that to what their annualized was in Q1. If they weren't employed in total in Q1, you'd have to annualize based on the time period that they worked in Q1. As you can see, this can get quite complicated. So here's the steps. I'm not going to go through how all this works, and I have examples in here so you'll be able to see, but just to mention what's changed since June 5th when the new law came into effect. If you do have an instance where you did reduce the employee's wage by more, or their hourly rate by more than 75%, there was a safe harbor that you could qualify for that basically you wouldn't be affected as long as you there was a reduction. When you look at how much they were being paid on February 15th, and then you look at between February 15th and April 26th, if they had a reduction, their annual salary or hourly rate compared back to February 15th, then as long as you restore that reduction, it used to be June 30th, and now the date is December 31st. So you'd have until December 31st to restore their annual salary or hourly wage. And a big question is, what happens if I restore it and then their wages dip again? Like I restore them in August, then struggling still because of COVID, so I have to reduce their salary. That's a big unanswered question. Do you just have to get them back up to what they were at one time between before December 31st? We don't know the answer, and hopefully there's more guidance that comes out on that. And here's just how the calculations work. You'll have the slides to go through this, and then you can reach out if you have questions. I'm just showing where, because of the law that Trump signed on June 5th, it changed the June 30th date to December 31st. And then here's the examples where it's being updated for the covered period. That's now, you have your 24 weeks with the option to use 8. And then here's the example based on an 8-week covered period, based on an 8-week covered period, and then more where the June 30th date's being changed to December 31st. And what I'm gonna focus more time on is the full-time equivalency. This is what a lot of people are running into, and I think it's actually the most complicated part of this application. So you have to determine what your average full-time equivalent employees were for the covered period. And how you do this is you're going to determine for each employee, determine the average number of hours worked per week. And you're going to divide their hours by 40. And you're going to round to the nearest 10th. So if you have an employee that works 40 hours, you divide by 40, they're going to be their FT equivalent is 1. If they work 50 hours, 50 divided by 40 is more than 1, but it's capped at 1. So their full-time equivalent would be 1. Now, if you have people that are working less than 40 hours, you might want to think about using the simplified method, which allows you to use 1 for all employees that are working 40 hours or more, and every employee that works less than 40 hours, you'd use a 0.5. The reason you're having to do this if you're doing the long form is you're going to have to calculate your FTs for your covered period, and then you're going to have to go back and compare it to 2 prior dates, or there's a third date if you're a seasonal employer. If you have a decline in your FTEs or your headcount over the covered period compared back to those prior periods, your quotient, your FTE quotient is going to be less than 1, which means the max amount of forgiveness that you can receive is going to be, it's not going to be equal to all the money you spent. So you'd end up being in a situation where you'd have to pay back loan proceeds. So here's an example of how the full-time equivalency works. If you have, see in the first row, employee A worked 50 hours, so he's a 1.0, even though 50 divided by 40 is more than 1, it's capped at 1. And then as you can see, these employees are working, a few employees are working less than 40 hours, and that's what their FTE number is, or the simplified method. And it's actually more beneficial to do the FTE, the regular method. Just keep in mind, if you end up wanting to use the simplified, you have to use it for all periods you're looking at, not just the covered period.
The one thing I would say about that is that it's not necessary that you do both methods. You know, if you do your basic method, not the simplified, or vice versa, you do one and you don't have FTE issues, then by all means you don't need to go through all the work to do the other method. But many people think that using the simplified method might not be as advantageous. It just might be easier. I've actually seen where the standard method shows a lower FTE equivalent than the simplified method, where simplified prevents the reduction. So it's just something to consider, doing both, just in case it provides a better result.
Okay, thank you, Collin. Okay, it's important to note when you're doing the average FTE, it's based on the hours paid, not worked. So if you were furloughing, or you're telling employees to stay at home, but you're still paying them, you would get to count the hours that you paid them even though they weren't working when you're calculating their FTE number. So just keep that in mind. And then right here, there are some exceptions to the full-time equivalency tests when you're calculating the your FTEs for the covered period. And this is what Collin originally talked about at the very beginning. If you have any positions where you made a good faith written offer to rehire an employee during the covered period and the employee rejected it, or you have any employees during the covered period who were fired for cause, voluntarily resigned, or requested and received a reduction in their hours, you can get an FT exception, which means you'd be able to count them as a 1.0, even though they were no longer, either they're no longer working for your business, or the last one where they were still there, but they had a reduction in their hours, you'd still get to count them as a 1. But the catch here is only if the position was not filled by a new employee. So I have an example of how this works. So the borrower has 2 employees, Rachel and Monica, at the beginning of the covered period. Rachel works 40 hours per week throughout the entire covered period. Monica works 40 hours per week for the first 2 weeks and is fired for cause. That's important. She's fired for cause. Chandler is hired at the end of week 3 and works 5 hours for that week. He works 35 hours per week for the remaining 5 weeks. Then you have Joey's hired in week 7 to replace Monica, which is key information here. Joey works 40 hours per week in 7 and 8. So at the top here, I have a recap of how many hours each employee worked. So what we're really going to be focusing on here is Monica. So based on the language and the instructions, Monica, she was fired for cause after week 2. So in week 3 through 8, she would be a 0, because in week 7, Joey was hired to replace Monica. Now, what a lot of, or some of the questions came through, should Monica count as a 1.0 until Joey is rehired, which would be more favorable to the borrower because it'd give you, at the bottom of each little calculation, you can see their FTE average. So for, based on the language and instructions, it's a 2 point, it should be 2.1. I forgot to round up to the nearest 10th. Now the FTE average, if Monica counts as a 1.0 until Joey's hired, is 2.6, which is more beneficial. But based on the language, it doesn't seem that you can count Monica as a 1.0 until Joey's hired. I think Monica has to stay at 0 for the remaining week 3 through 8 because someone was rehired to take her position. Now, what's even more beneficial is, what if Joey's hired for a new position, does not replace Monica's position? You can see how Monica counts as a 1.0 through week 3 through 8. So you end up with the FTE average, which would come out to a 2.8, which is way more beneficial for Joy to be hired for a new position than replace Monica's position. Okay, and why do you need to calculate all this stuff and count your hours for employees? Because this is the second possible reduction you can have to your forgiveness amount. Just to recap, remember, you get your loan, you spend your money over the covered period. You spend all your money, you think you can go apply for forgiveness, get it full of forgiveness. Wait a second, you have two things you have to watch out for. Did you reduce your employees' wages during the covered period, which we went over a little bit before? And the second one is this full-time equivalency reduction. This is the second one related to your headcount. Did you reduce your headcount during your cover period versus these prior look-back periods? So what it says is your forgiveness is reduced if your average number of full-time equivalent employees during the covered period is less than your average of FTEs for any of the following periods at your election. So what you're going to do is you're going to choose the lesser of the first two. And if you're a seasonal employer, you have that option as well. Basically, you want to choose whatever period gives you the least amount of FTEs, because what you're doing is comparing your FTEs over the covered period versus these periods. You want your FTEs over the covered period to be more than these periods, or you're going to get hit with the reduction. And they like to make it complicated, so there's 2 FTE safe harbors that would prevent a reduction from occurring. But let's just do an example of how this reduction works if you didn't meet the safe harbors. So you have a business that has 10 FTEs during your 8-week cover period after you receive the loan proceeds. During February 15th through June 30th, 2019, this is your first look back period, you had 16 FTEs. And then your second look back period is January 1st, the first 2 months of 2020. So in both of those periods, you had 16 FTEs. Okay, now you have a problem. You have more FTEs in the look back period versus your cover period where you only had 10. So you take 10 divided by 16 and you get 62.5%. So what this comes out to be is basically your forgiveness amount is going to be reduced by 37.5%. So if your loan amount was 100,000, you spent the full 100 in your 8-week period, well, this is bad news for you, because only 62,500 would be able to be forgiven. The other 37,500 would not be able to be forgiven. You'd owe that back. But there are 2 safe harbors. And to mention too, again, this is why you want to use the easy loan application if you can, because you don't have to do any of this stuff that I just talked about, because you basically have the get out of jail free card if you can meet that FT exemption. That's the third checkbox on the easy instructions that would allow you to use that form. And if you can't use the easy application, you have this safe harbor again that I discussed earlier on in the presentation. So it might, even if you do have a reduction of your headcount during the cover period, if you can meet this safe harbor right here, then you're going to be okay. You won't have any FT or reduction because your headcount was reduced. And this is just the exact same stuff I discussed earlier. Just keep in mind you have to have documentation for the COVID requirements at business location, and you might have to provide your financial records. This is the second safe harbor. This has been there before the president signed that law on June 5th, but just to recap, if the borrower reduced its FT employee levels in the period beginning February 15th and ending April 26th, so if you look at how many employees you had on February 15th, your FTs count on February 15th, and compare it to February 15th through April 26th, if you had a decline in your FT levels and you restored that FT count back up to your February 15th amount not later than December 31st, you would you'd meet the safe harbor. And if you had a reduction based on what we were talking about previously, where you look at your FTEs over the covered period and compare it back to look back periods, if you did have a reduction but you met this safe harbor, then it wouldn't matter because you meet the safe harbor and you're okay. To mention why it's in red, not later than December 31st right there, it used to be June 30th. And most important thing about meeting the safe harbor, you have to have a reduction between February 15th and April 26th compared back to February 15th. If you actually increase your FTEs during that February 15th and April 26th period, then you would not be able to use this safe harbor. And this is the example of how it works. February 15th, you had 15 full-time equivalents. February 15th through April 26th, you had an average of 10. So you did have a drop. So you meet the first part of the safe harbor. Now you have to get your FTEs back up to 15, which was your February 15 count, by December 31st or earlier. And then determining final loan forgiveness. This is what the application does. It's going to be your forgiveness amount is going to be the lesser of. It's going to be your total payroll costs and non-payroll costs less your salary and hourly wage reduction multiplied by your FTE reduction quotient, or your PPP loan amount, or your payroll costs divided by 60%. So whatever, when you do the math, whichever one it's the least amount, your forgiveness is going to be limited to that. And then lastly, the loan process, and then I'll turn it back over to Collin. So the loan forgiveness process, you must submit a complete application to your lender, and the lender has 60 days from receipt of a complete application. Keyword there, complete, not partial application. So once your lender has the complete application, they have 60 days to issue a decision, and then the decision may take the form of approval, denial, or denial without prejudice. And if you do have a denial, you can request the lender to reconsider your application unless the SBA has determined that the borrower is ineligible for a PPP loan. And then if you don't apply for forgiveness within 10 months after the last day of your covered period, the PPP loan is no longer deferred and you must begin paying principal and interest. And then if you, this is if you go to treasury.gov, a lot of people have asked, where do you find all this information? Treasury.gov, and then if you look at that red highlight up at the top, you can't miss it. It says for small businesses seeking directly from COVID-19, click here. Click there, it gives all the information about COVID that the SBA and Treasury have released, and you can find the most up-to-date information there, including the applications and all the guidance. And then here's Collin going to talk about some common mistakes that we see.
All right, thank you, Denver. All right, everybody, that's a lot of information, but that's our best attempt at trying to narrow it down to an hour, and we're sitting actually a little bit more than an hour. All right, this is where we will go over some of the key things that we've identified in working with our clients and other relationships that we think would bring value to you in your evaluation of how you handle PPP. Okay, the first item is more of a procedural in how you apply your payroll. As Denver mentioned, there are caps to where you can only take a certain amount of payroll expense per employee. We've seen many instances where folks have done the calculations, they've come up with the weekly cap, and they've applied basically that amount per week for the 8-week period, or for some monthly or whatever it might be, applied that cap to each payroll. You should really accumulate or add up payroll from your first payroll through your last payroll, and only cap it when that total payroll hits the cap, not on a cap per payroll cycle. In many cases, you might either over-include or under-include wages in that calculation. The second one is the paid or incurred, and that's really important because especially when you're actually looking at trying to get this closed out in your 8-week period as opposed to going beyond 8 weeks. Paid or incurred, the key thing there is the front end of your eligible expenses, specifically payroll, is on a cash basis. So that means that, let's just say that your first payroll after receipt of the funds is the day after receipt of the funds. That is included even though none of the underlying expenses related to the 8-week period. Then you keep working through on cash basis. And then at the end, let's say that you have the end of your 8-week period was June the 12th. And then you have another payroll on June the 15th. And the June the 15th payroll includes payroll that was earned during the 8-week period. Well, you get to accrue that in. And it doesn't stop there. If you're paying a week or 2 weeks in arrears, you might have another payroll later that includes some payroll that was earned during that 8-week period. So you need to make sure that you're evaluating on an accrual basis on the back end. Now, that might be applicable for rent. Normally isn't. Normally rent's paid at the beginning of the month for the month in use. But if you think of your utilities, they are absolutely always in arrears. Now, granted, utilities don't move the dial as much, but every little bit helps. All right, next item is the FTE calculation. So we've already gone over some of that. So key item here is, does it matter if I have different employees during the covered period versus look-back periods? And the answer is no, it does not matter if you have that, because if somebody's hired or they're fired. If they're hired, they're added to it. If they're added to it as a replacement of a person who was fired, then it's probably an employee versus employee. Key is just make sure you're aware of what the exceptions are under that piece. Then the wage reduction calculation. Employees that are hired or fired during the covered period, you need to make sure you understand how that works, and does reducing the hours of an hourly employee affect the calculation. And Denver's gone over that, but it's different for a salaried person versus an hourly. All right, let's go to the next. Okay. All right, we talked about that already. Still using the 25% of non-payroll cap as instead of the 40%. So just be aware of that. And then also the FTE reduction safe harbor. Just don't know, you shouldn't just use the June 30th. You can reach that safe harbor at a later date. All right, commonly asked questions here. How do I get help with your application? As I mentioned before, we can certainly help you. Your CPA or advisor might be versed in it, but I would absolutely recommend that you get with somebody that can provide you guidance so that before you make that application, you know that you're doing it correctly. You have the right story built, especially if you have a loan of greater than $2 million. You're going to have greater scrutiny. Also know that your application itself is going to be with your lender, but the SBA will have up to, I believe, up to 3 years or 5 years. I forget. You remember Denver? Is it 3 or 5 years? They'll have a period. I think. 6 years? Okay. They'll have a period beyond, the 3 was the 3 months. They have 3 months to review your application for forgiveness. The bank does. So you need to make sure you've got all of your information pulled together, retain it like you would for a potential IRS audit, and just make sure that you have all that there. That way, in case you are audited by the SBA at some point in the next 6 years, you have all your information together. Okay, if I'm using the 8-week period, can I apply immediately after the 8-week period is over? The answer to that is theoretically yes, but the theory stops there. It really comes down to your lender. Some lenders are not ready and they're not accepting applications yet. Some are. I'm not really hearing any that are, but I think some are. So you just need to make sure you're ready, and then reach out and communicate with your lender, find out when they're going to have it available, and then find out when they'll start accepting applications. But in the meantime, get it all together, get it all proofed out, make sure you're comfortable with it, make sure you're not missing out on any of these items. Next one is, can I apply for loan forgiveness before the end of the 24-week period? And we've covered that a little bit. The answer to that is yes. If you don't do the 8-week period, you don't have to wait till the end of the 24-week period. That's okay. You can do it some point in between, You got to make sure that you're still addressing appropriately your FTE reduction or your wage reduction. This is one that we still have to answer questions to. And that's okay, it's confusing. Remember, eligible payroll costs, it does not include 1099 contractors. Those contractors are eligible to apply for their own PPP loan. So since they're eligible, they're not includable in your total payroll. And if your argument is, well, they're really like employees, you probably have other issues you should look at. If you're controlling them, I don't want to go into all these details here because that opens up a can of worms, but you should always evaluate your 1099 contractors to see if they really should be classified as W-2 employees, okay? Now, can I record an estimated forgiveness amount on my P&L? You know, while every business and every controller and owner can handle it how they want, best practice, it really would be that you would not record the reduction in the loan until you actually get notification of that reduction. If you do something based upon estimates, you're really just kind of more manipulating your internal numbers. As a business owner, it's better to really know, how did I truly perform? How did I do through all of this, regardless of whether I had the safety net from the government? You want to know what are your true expenses and not have them offset and reduced by this forgiveness piece. And so it might be that you say, all right, I know I'm going to have it forgiven, and they even tell me that it's been forgiven. Do you take that in as an operating income, or do you treat that more as like a 13th month or a tax return type entry, so that you can truly see year over year over year, how did I perform in my operations versus all the prior years? All your prior years don't have that forgiveness piece coming in. So do you want that to come in, and every year you have to reconcile that to say, oh, well, that was the year I had that in. And okay, it's not really comparable. So that's something to consider and to evaluate. You also, when you take it in as income, you want to make sure that's not affecting your compensation of employees, whether it's a department manager or a general manager or somebody else that gets a bonus or a commission based upon the profitability of the company. Unless you want to. You might choose to, that's fine. Don't inadvertently take it in and pay more to somebody that you're not intending to. All right, the last item is, while I understand the forgiveness is non-taxable, is there any chance we'll be able to deduct the underlying expenses? And the answer is, we'd love it if that was the case. And there's a lot of rumbling saying that everybody is still working hard to try to get those underlying expenses deductible. Right now, they're not. Doesn't mean that we might not hear something one way or another before you start filing for 2020, but there's a chance that there's a chance you might. And boy, we would all be really lucky if they did. All right, let's see, do we have any other commonly asked, or was that it? That was it. I think the only other item I would mention in the commonly asked questions is if you're going to that 24-week period, it doesn't mean you go to the end of the 24-week period, but there's a chance that you might not find out that you got forgiveness until 2021. And so what happens then? So you have all of the expenses, and then your income comes in 2021, but your expenses were incurred in 2020. How do you match that? And it's not so much a question for tax, because for tax, if it bridges over, likely what happens is all those underlying expenses, if they don't make them deductible, would be non-deductible expenses on your 2020 tax return. Then the income comes in it'd be expense non-deductible in 2020 tax return, and then your income would be a non-income forgiveness of debt in 2021 that then makes it to where the expenses are taken in against the income, and you move forward. I'm sure that's nice and complicated to consider, but it's something you need to consider if you bridge over to the next year. Because remember, they have 3 months. So when you make your application, it doesn't mean that they start working on it right away. The other one is for your book purposes. How do you handle it if you're a company that has a review or an audit or something that's gap-based? How do you mesh that, and how do you handle those expenses and the inevitable income? So that's other things you got to consider. It's quite interesting. So Anyway, we're going to open it up to questions if there are any. I see one that's out there from Rob. How will interest from the lender apply once the forgiveness response? I'm not sure exactly what that means, but I'm going to guess. Our understanding is that interest will not accrue until the forgiveness is determined. And so I believe that the interest on the amount that's forgiven would not be incurred. Is that correct, Denver?
Yeah, so my understanding is that once they got the loan, day one, the interest started accruing, but it's deferred until the loan application, there's a decision from the lender. And if you receive full forgiveness for the full value of the loan that you originally received, the entire amount of the interest would be forgiven. But if you do not receive full forgiveness, so you got $1 million loan, but then you only got 800,000 forgiven, my understanding is you would have to pay interest on that 200,000 based on when you received the loan at the very beginning. It's just the interest is being deferred until there's a loan application decision from the lender.
All right. Thank you, Denver. Are there any other questions from the group? And if not, we'd really do appreciate you having us today. Love to hear from you if you have any other questions that come up. I know our emails were included in the presentation. We'll provide the presentation to Michael so that he can disseminate it to you all if you would like to see it. It has our email addresses in there, and of course you can reach out to us through askus@lgt-cpa.com. I'd like to thank you all for coming, and I can turn it back over to Michael in case he has any parting words.
I just want to say thank you, Collin, Denver, and Patrick, for that presentation. That was a lot of information, and it's yeah, and not sure what else to say. That was a lot of information, and I appreciate you taking the little over an hour out of your time to help our chamber members and our business community by sharing that. The presentation was recorded today, so we will post the link to that on the chamber website, and I'll likely send that out in a status update today or tomorrow, and along with the presentation, we'll make that available as well. So thank y'all for presenting, and thank those of you who came and participated in the webinar today. Y'all have a great day.